What we saw last week in the GDP and the domestic consumption activity numbers was that drag from services, but a pickup in consumption. On the balance, is there really any reason for the PBoC to dramatically adjust policy?
On a balance, we saw three things out of the GDP numbers last week. We saw growth rebounding on a year-on-year basis, and that is due to a base effect surrounding COVID disruptions last year. On a sequential basis, we saw GDP coming in flat, and that was a result of all of the disruptions surrounding COVID-19 cases this year in February around Chinese New Year. And the third thing we saw is that we saw retail sales picking up significantly, exceeding consensus and pointing towards that shift towards consumption away from exports and manufacturing. Now, we do think that that consumption data might have been skewed to the upside. The recovery isn't entirely broad-based, as the PMI numbers suggested in March. On the employment front in particular, there remains some weakness. And as we've seen, excessive tightening in March did lead to some pressure on the credit market front. So while there is no need to shift gears in terms of making policy more accommodative, potentially as we head into April, we will see PBoC perhaps adopting a more prudent approach towards that policy tightening with the view of continuing that gradual tightening or deleveraging effort that will take place in the remainder of the year.
So the LPR is expected to stay essentially where they have been for quite some time. What are the biggest challenges in terms of maintaining momentum in this recovery now?
Well, we don't expect the loan prime rate to change, of course, but there are a lot of things that the PBoC could do to continue to maintain liquidity. We saw last week that they injected through the medium-term lending facility just enough to offset some of the debt that was maturing, but not in excess to sort of continue fueling debt bubbles. Going forwards, we do expect to see this growth momentum slowing slightly as we shift from exports and manufacturing to consumption, so slower growth, but of better quality. That means that in Q2, we will see GDP slowing to about 6.1% on a year-on-year basis and 5.5%, which is below the target of 6% for the remainder of the year. Although we do expect to see a pickup in sequential growth. So depending on which figure you're focusing on, it's a good or bad news.
Right.
But there are three key risks to this outlook going forward. And the first one is, of course, an excessively aggressive pace of policy tightening. The second is this delay on the pace of vaccination rollouts. And the third one would be ongoing geopolitical tensions between the US and other partners.
Hold on a second, because we're getting Japan breaking news right now. This is exports in Japan year-on-year growing 16.1%, which is beating estimates of growth of around 11%. It's also a reversal from the previous month when we saw contraction in Japanese exports. And imports also beating expectations, growing 5.7% in March year-on-year. A slight easing of the gains from the previous month, but this leaves us a surplus adjusted of 297.8 billion yen for the trade balance in March. And this is also coming from a revised 11 billion trade deficit in the previous month. So all in all, just to say that the numbers are better than expected. So let's go back to our guest and just continue this conversation with Carlos. Let me ask you about Japan, because we are now seeing great numbers when it comes to exports to China, rising 37.2%, to the US, moderating a little bit, 4.9% again year-on-year. How much will Japan be helped by all of the strength that we're seeing in trade in Northeast Asia, especially from demand coming from the US and China as well?
Well, definitely both markets are key export markets for Japan, and both markets are going to lead in this global recovery out of the COVID-19 pandemic. So Japan is one of the countries in the region that will benefit the most from increased demand from China and also the US, especially in the first half of the year. Notwithstanding this export-led growth, which has been it's basically been underpinning the sort of better momentum in the Japanese economy since Q4. Bit of a dip in Q1 as a result of the state of emergency measures that are now extended into May, but we do expect that this will remain supportive this year as well. What is really going to be a drag for the Japanese economy is a pickup in demand. All eyes on the Tokyo Olympic, but unfortunately, given the progress with the virus and the vaccine rollout over there, it might not add up as much to activity as we initially expected.
At least, Carlos, Japan seems to be helped right now by a weaker Japanese yen, which is holding at that 108 level towards 109. What's the trajectory here?
Well, we do expect to see a little bit more sort of upside to the Japanese yen, predominantly as a result of the US dollar narrative. We have seen US dollar appreciating slightly in the past weeks, but that has not been, in the same order of magnitude as the pace of US yield curve steepening. So, of course, that is something that is helping a lot of emerging markets in Asia. But for Japan, we do not see this. We don't see the yen depreciating significantly. We also don't see the yen appreciating because, we have this ongoing debate with the US dollar where long-term weakness as a result of that widening current account deficit with imports increasing in line with the economic recovery domestically in the US, that is going to exert downside pressure on the dollar in the second half. And also, once the optimism surrounding the recovery is over, it's going to be time to reckon with the public debt. So that is something that's going to drag as well.